Investing basics. Understanding bonds. Investing in bonds is one of the most fundamental strategies for building wealth, preserving capital, and generating stable income. Bonds are often considered safer than stocks, yet they play a critical role in any diversified investment portfolio. This guide will break down the concept of bonds, their types, features, benefits, risks, and practical strategies for investing. 1. What is a bond? A bond is essentially a loan that you, as an investor, provide to a government, corporation, or other entity in exchange for interest payments and the return of your principal at a specified future date. In simple terms, buying a bond means lending your money. For example, imagine you buy a bond issued by a corporation for $1,000. The corporation promises to pay you 5% interest per year and return the original $1,000 at the end of 10 years. In this scenario, the bond acts like a fixed income investment that provides predictable cash flow. Unlike stocks, which represent ownership in a company, bonds are debt instruments. This means you are a creditor rather than a shareholder. If the issuer goes bankrupt, bondholders are usually paid before stockholders, making bonds a lower risk investment compared to equities. 2. Key features of bonds. Understanding the basic characteristics of bonds is essential for any investor. Face value, par value. The face value is the amount the bondholder will receive at maturity. Most bonds are issued in denominations of $1,000. This value does not include the interest earned over time. Coupon rate. The coupon rate is the annual interest rate the bond pays. For instance, a bond with a 5% coupon and $1,000 face value pays $50 annually. Some bonds pay interest semi-annually, quarterly, or monthly. Maturity date. The maturity date is the day when the issuer must repay the bond's principal. Bonds can have short-term, less than 3 years, medium-term, 3 to 10 years, or long-term, 10+ years maturities. Issuer. The issuer is the entity borrowing your money. This could be a government, federal, state, or municipal, or a corporation. The issuer's creditworthiness affects the bond's risk and return. Price. Bonds can trade above or below their face value in the secondary market, depending on interest rates, credit risk, and supply-demand dynamics. A bond priced above par is said to trade at a premium, while a bond below par trades at a discount. 3. Types of bonds. Bonds come in several varieties, each with unique characteristics and risk profiles. Government bonds. Issued by national governments, these bonds are considered low risk since the government can raise taxes or print money to repay debt. Examples include U.S. Treasury bonds, UK gilts, or German bunds. Municipal bonds. Issued by local governments, cities, or states, municipal bonds often offer tax advantages. Interest earned is sometimes exempt from federal, state, or local taxes. They are relatively safe, but slightly riskier than national government bonds. Corporate bonds. Issued by companies, corporate bonds typically offer higher yields to compensate for increased risk. Companies are subject to business risks, market competition, and economic conditions. Credit ratings by agencies like Moody's or S&P can help assess a company's default risk. Zero coupon bonds. These bonds do not pay periodic interest. Instead, they are sold at a discount to face value, and investors receive the full face value at maturity. The difference between purchase price and face value is the investor's profit. Convertible bonds. Convertible bonds allow investors to convert the bond into company stock at a predetermined rate. They combine the benefits of fixed income with potential equity upside. Inflation-protected bonds. Examples include TIPS, Treasury inflation-protected securities in the U.S. The principal value adjusts with inflation, protecting the investor from a loss of purchasing power. 4. Benefits of investing in bonds. Bonds offer multiple advantages to investors. Steady income. Bonds pay predictable interest, often annually or semi-annually. This makes them ideal for retirees or anyone seeking cash flow stability. Safety. Government and highly rated corporate bonds are considered low risk. They are more secure than stocks during market volatility. Diversification. Bonds reduce portfolio risk when combined with equities. They usually move inversely to stocks during market downturns. Capital preservation. Bonds typically return the principal at maturity, making them a safe place to store funds compared to riskier assets. Tax benefits. Certain bonds, such as municipal bonds, provide tax-free interest income. 5. Risks of bonds. While safer than stocks, bonds are not risk-free. Understanding bond risks is crucial. Interest rate risk. Bond prices move inversely to interest rates. If rates rise, existing bonds with lower rates lose market value. Credit risk. Default risk. The issuer might fail to make interest payments or repay the principal. Government bonds have minimal default risk, whereas corporate bonds vary based on the company's financial health. Inflation risk. Inflation erodes the purchasing power of interest and principal. Fixed-rate bonds are vulnerable if inflation rises significantly. Liquidity risk. Some bonds, particularly corporate or municipal bonds, may not be easily sold in the market, making them harder to liquidate. Reinvestment risk. If interest rates fall, coupon payments may be reinvested at lower rates, reducing total income. 6. How to invest in bonds. Investors can access bonds through several channels. Direct purchase from government. In the U.S., platforms like Treasury Direct allow investors to buy Treasury bonds, bills, and notes. Through brokers or banks, corporate and municipal bonds are often purchased via brokerage accounts. Bond ETFs or mutual funds. Bond exchange-traded funds or mutual funds pool money from multiple investors to buy a diversified portfolio of bonds, offering convenience and diversification. Robo-advisors. Automated investment platforms often include bonds in diversified portfolios. 7. Example of bond investment. Imagine buying a $1,000 corporate bond with a 5% annual coupon and 10-year maturity. Yearly interest, $50. Total interest over 10 years, $500 principal returned at maturity. $1,000 total return equals $1,500. The investment is low risk if the company has a strong credit rating, providing steady income over time. 8. Practical tips for bond investors. Diversify. Invest in different types of bonds to reduce risk. Consider maturity. Match bond maturities to your financial goals and cash flow needs. Check credit ratings. Use agencies like Moody's, S&P, or Fitch to evaluate issuer reliability. Monitor interest rates. Rising rates can lower bond prices. Falling rates can increase them. Understand tax implications. Municipal bonds may be tax-free, whereas corporate bonds are taxable. 9. Conclusion. Bonds are a vital tool for any investor seeking stability, income, and diversification. They are loans you make to governments or companies, offering predictable interest payments and return of principal. Understanding bond types, features, benefits, and risks can help you make informed investment decisions. Whether you are a beginner or an experienced investor, adding bonds to your portfolio can reduce risk, preserve capital, and provide steady income. By combining bonds with stocks and other assets, you create a balanced investment strategy that can weather market fluctuations while meeting long-term financial goals.
Don't forget to like, share, and subscribe, and hit the bell so you never miss a video.